Hi friends, let's say you built a portfolio of 25 lakh rupees and it contains stocks and mutual funds. Now because market is in downtrend, let us assume that unfortunately your portfolio is also down by 30%. So your 25 lakh rupees of investments have become 17 lakh 50,000 rupees. Now if you need some money for let's say short term duration, maybe you might need 1 lakh rupee, 2 lakh rupee, 5 lakh rupee or this entire 17 lakh 50,000 rupees. If you need this money for short duration, maybe let's say 6 months, 1 year or 2 years, the question is what should you do here? Should you withdraw this money from your mutual fund or stock portfolio and use this money? Or the option 2 is you might take a loan for a short duration, and the question is which is a better option? So pause this video, let me know in the comments what is your preferred option. In my view, both these options come with pros and cons, and it also depends on lot of factors. So let me break down each and every point in a very simple, easy to understand language so that you can make an informed decision for yourself. If you don't know me, my name is Rahul Jain. I'm a full-time investor and a full-time content creator. With that, let's get this video started. So let us work through the option number 1, which is that you go and sell your stocks or mutual funds so that you can take care of your short-term money need. And let us assume that you withdraw the entire 17 lakh 50,000 rupees because maybe you are buying a property, or maybe you have to invest money in your business, or maybe there is an emergency situation that you have to deal with. Sometime that happens. So therefore, let us assume that you withdraw the entire 17 lakh 50,000 rupees from your portfolio for next 2 years. And after 2 years, you are ready to put this money back into market. So what happens here? Let us take some timelines. So let us assume that on 1st of January 2025, you decide to withdraw 17 lakh 50,000 rupees, meaning that for the next 2 years, which is up to 1st of January 2027, you have 0 rupees in your portfolio. Your portfolio is not generating any returns. And let us say on 1st of January 2027, you bring back exactly 17 lakh 50,000 rupees back into your portfolio. Now let us also assume that you want to retire by 2045, meaning that you are going to leave this money invested for 18 years so that this money can compound. And let us also assume that it compounds at 12% yearly returns. So by 2045, in this particular example, your money will grow to 1 crore 35 lakh rupees roughly, give and take. So in this option 1, I have assumed 17 lakh 50,000 rupees, but this amount can be anything. It could be 1 lakh, 2 lakh, 3 lakh, depending on your need. 2 years doesn't need to be necessarily 2 years. It could be 6 months. It could be 1 year. But here I have assumed 17 lakh 50,000 rupees and 2 years so that we can have some like for like comparison. So in summary, in option 1, we are going to see 1 crore 35 lakh rupees of portfolio after 2045. Let me now work through option number 2, which is you remain invested in your portfolio. Instead of breaking your portfolio down, you take a loan. So what does the situation look like there? So in option 2, what you're doing is you're leaving your entire portfolio as it is. You're not touching anything. You're not selling any stocks. You're not selling any mutual funds. What you are doing is instead you are taking a loan of 17 lakh 50,000 rupees. Let us assume that on 1st of January 2025, you decide to take a loan of 17 lakh 50,000 rupees for the next 2 years so that your short-term need is fulfilled. Of course, you will have to pay interest on the 17 lakh 50,000 rupees. I'll show you how to calculate that as well. But for a moment, let us now consider 4 possible scenarios in the future. So scenario number 1 is, let us say that stock market recovers within 6 months of time period, meaning that by June 2025, stock market recovers. So of course, your portfolio is going to recover, and let us assume that you do full recovery in your portfolio and your 17 lakh 50,000 rupees of portfolio now becomes 25 lakh rupees, goes back to the original value. That is scenario number 1. Scenario number 2 is that it is possible that it may not recover within 6 months of time period. Let us say it takes 12 months of time for recovery, and the full recovery happens by 1st of January 2026. That is scenario number 2. Scenario number 3 is that recovery takes even longer. It is entirely possible, and let us say that it takes 2 years of time for your portfolio to recover back to original value of 25 lakh rupees. So it comes back on 1st of January 2027. Let us also consider scenario number 4, which is that not only your portfolio recovers in next 2 years of time period, in fact, it goes up by let's say 10% from its original value. So from 25 lakh rupees, it goes to 27 lakh 50,000 rupees by 1st of January 2027. Now let us work through all these 4 scenarios and see what happens to your portfolio by 2045, which is your retirement period. I'm going to consider again the same 12% yearly returns here. So in scenario number 1, your money gets compounded for 19 years, 6 months of time period, and it comes out to be around 2 crore crore 28 lakh rupees, assuming 12% returns. In scenario number 2, your money will be invested for slightly shorter period of time, which is 19 years. It will come out to be 2 crore 15 lakh rupees. If you look at the scenario number 3, which is 2 years of recovery time frame, your money will compound for 18 years here. Your money will become 1 crore 92 lakh. And scenario number 4, which is 10% rally after the recovery, you see in 18 years of time period, this money will become 2 crore 11 lakh rupees. So these returns are definitely much better than 1 crore 35 lakhs return that we saw in the option 1 here. But of course, now we need to factor in the cost of the loan as well, because that is a negative outflow from a cash flow perspective. So let us assume that you are taking a loan at 11% per year interest. Again, this is an assumption here. It could be 10%, it could be 13%, depending on what you're doing with your loan. But let us assume that 11% per year is the interest, and you are paying this interest on this entire 17 lakh 50,000 rupees for 2 years of time period. So your total interest payment will come out to be 3 lakh 85,000 rupees. Now you may say that, Rahul, this 3 lakh 85,000 rupees, if I went with option 1, I would have this money with me and I can invest it for, let us say, remaining 18 years of time period, which is how we need to calculate what is the cost of this loan over a longer period of time. So if I do some calculation, let us say that if you were to invest this money 1st of January 2027, for simplicity I have taken, next 18 years, this 3 lakh 85,000 rupees also can grow, and therefore by 2045, this loan value would have become 29 lakh 65,000 rupees if you did not take this loan. This is if you are comparing option 1 and option 2. In option 2, this is a negative impact of taking a loan. So I'm factoring the time value of money of this interest component by not just saying it is only going to impact by 3,85,000 rupees. No, because in option 2, this is a negative impact. I hope you understand this point. So therefore, the negative impact comes out to be 29,65,000 rupees. Now let us go back to our scenarios and remove this money from our corpus to take care of the negative impact. So in scenario 1, 6 months period, this was money which was 2 crore 28 lakhs comes down to 1 crore 98 lakhs. In second scenario of 12 months, your 2 crore 15 lakh would not be 2 crore 15 lakh. It will be minus 29 lakh 65,000 rupees. It comes out to be 1 crore 86 lakh. In 24 month scenario, third scenario, your 1 crore 92 lakh rupees will need to be adjusted for this 29 lakh 65,000 rupees of negative impact. So your net becomes 1 crore 62 lakh rupees. And finally, in the option 4, your 2 crore 11 lakh rupees will not be 2 crore 11 lakh rupees by factoring it into 29 lakh 65,000 rupees. So it comes out to be 1 crore 82 lakh. Now if you look at these mega summary of these 4 scenarios under option 2 and compare with option 1, in option 1 we had 1 crore 35 lakh rupees of total corpus by 2045, but in these 4 scenarios, your money is more than 1 crore 35 lakh rupees. So if you go by these calculations, option 2 looks very, very attractive. But please do not forget, I have assumed here that your portfolio is going to recover either in 6 months, 12 months or 2 years of time period, which may or may not happen. That is the possibility that you have to factor in. It may take 3 years of time period. What does past data tell us? Let me now analyze past data as well from a market perspective. So if we go back to last 5 years of market falls and try and understand what has happened in the past, have a look at my screen. You will see during the COVID fall, it took Nifty to recover back to its original levels. As you can see here, it went down and it went up. It took almost 9 months of time period. If you go back to October 21 to December 2022, you will see that it took stock market, which is Nifty 50, to take almost 14 months to fully recover from the fall that we are seeing here. If you go back to the third fall, which is July 2023 to December 2023, it took Nifty to almost 6 months to recover fully. Right now, from September 2024 to almost March or April 2025 now, market has been down for almost 6 months. I do not know how much longer it is going to take for us to see the recovery in the market. But please also understand, this is the market recovery. This could be very, very different for your portfolio as well. So it really boils down to your portfolio level details that you need to understand and you need to have a conviction in. If you think that your portfolio can definitely recover in the next 2 years or 3 years of time period, then going down the loan route makes sense. But if you think that you've taken riskier bets, for example, if you've gone to micro caps or small cap, it may not be possible for recovery to happen. I have given you both the views here and I have remained totally unbiased so that you understand both the worlds here. Now, if you want to explore loan as an option, which is option number 2, then there are 2 options you can consider when it comes to loans. Option number 1 is that you can consider personal loans, and option number 2 is you can consider loan against securities, which is called LAS. Let me now break down the pros and cons of both these options as well. So parameter number 1 is the interest rate. So in personal loans, typically the interest rate that might be available is between 10% to anywhere 20%, and it entirely depends on your CIBIL score. So for example, some of you might get a personal loan at 10%, some of you might get a personal loan at, let's say, 14% or 15%, depending on your CIBIL score. While in case of loan against securities, the loan is not offered on the basis of your CIBIL score. It is offered at a fixed interest rate typically, and it depends on the platform that you're buying this loan from. The interest rate can vary somewhere between 10 to 12%. For example, right now Zerodha is offering at 11%. It is not a promotion of Zerodha, but I'm telling you real examples so that you can understand the difference between interest rate. So when it comes to interest rate, it really depends on whether you are getting a cheaper personal loan or whether you're getting a cheaper loan against securities. The second factor that you need to consider is the foreclosure charges. Foreclosure charges is that, let's say you take a loan for 2 years of time period and you pay it back within 1 year of time period. You do not run it for the entire 2 years. In that case, because you're making the early payment, what are you going to charge with? In case of personal loans, there may be some penalties. Please make sure you check with your provider. In case of loan against securities, typically there is no charges. There are no penalties for foreclosure charges. Therefore, in my view, when it comes to foreclosure charges, loan against securities is slightly better option. Third parameter that we need to consider is the part payments, which is, let's say that you take a loan for 20 lakh rupees for 2 years, but after 3 months you want to repay 10 lakh rupees. This is called part payment, and typically you have to again check in personal loans what the terms and conditions are. In case of loan against securities, typically there are no penalties if you want to make early payments. So there is definitely an advantage here. So unless you're getting the same deal in personal loans, in my view, loan against securities offer flexibility, more flexibility, but please make sure you read the terms and conditions in both the cases, because it is extremely important for you to understand the terms and conditions. The fourth point is the late payments or the penalties. What happens in case you're not able to make your payments on time? In personal loans, the penalties could be somewhere between 0 to 36%. Really depends on the provider that you're going with. In case of loan against securities, there are 2 types of models that I've seen. Model number 1 is if you make a late payment, you're charged a fixed amount. It could be 1,000 rupees, it could be 2,000 rupees, depending on the provider. The second model that I've seen is that there may be a penalty, which is very similar to what happens in the personal loans. It might be again 10%, 12%, 18%, depending on the provider. So before you take the loan, what you need to do is check what are the late penalty clauses in terms and conditions for both personal loan and loan against securities before you make a decision. The fifth and the final parameter is pledging. So in case of personal loans, you are not really pledging anything, but in case of loan against securities, you are pledging your portfolio. So in case you are unable to make payments, then the provider has the rights to sell off your portfolio to be able to recover their money. So these are the 5 differences that you need to understand and read through before you go to either of these options. I've given you the details what you need to look for. Now, in case you decide to go with loan against securities, the process is extremely simple. Let me actually show you the process using Zerodha as an example. It is not a promotion by Zerodha. I am simply trying to show you the complete picture here. So if you go to zerodhacapital.com, it will ask you to log in using your Zerodha Skite application. Once you do that, it will recognize you and it will ask you to create your Zerodha Capital account. Now you will undergo some email and phone OTP verification, very normal process. Then it will go through your KYC process using the Aadhaar card. That is also very common against many other providers as well. Moving on, then it will ask you to do bank account verification because the money will come into your bank account. After that, you will have to confirm the Demat account details, and then what it will do is it will fetch all the securities from your Demat account, all your stocks, mutual fund holdings, and it will show you how much of loan you can actually take. And let me speak about how much loan can you actually take. It's an important one that you need to understand. So let us say that your total portfolio value at the time of applying for loan is, let us say, 25 lakh rupees. So typically these loan providers will give you loan up to 50% on your equity portfolio. So if this 25 lakh rupees is made up of stocks and mutual funds which are equity based, then you are likely to get 50% of this 25 lakh rupees, which is 12.5 lakh rupees of maximum loan. Whether you take entire 12.5 lakh or not, it really depends on your needs. But if this 25 lakh portfolio was into debt mutual funds, for example, in that case, you can take up to 80%. Again, these are very, very typical standard ones that I have seen. It might vary from provider to provider, but typically you will get 80% of debt mutual funds, which in our example, 80% of 25 lakh rupees is 20 lakh rupees. You may have another question here. You may say that, Rahul, what happens to our stocks and mutual funds during this loan period? So the ownership of these stocks and mutual funds remain with you. You are the owner during the loan period. However, because you are pledging your stocks and mutual funds, there is a lien that gets created on your portfolio, meaning that you have limited ownership. What do I mean by that? I simply mean that if you want to sell your entire portfolio during the loan period, that will not be possible. You will be able to sell part of this portfolio depending on how much of loan you have taken and how much of lien that has been created. But please understand that you have given your stocks, your mutual funds as a collateral, as a security against the loan that you are taking. So unless you repay this entire loan back, there would remain a lien, but the lien will depend on how much of loan you have taken. So let's work through an example. You had the portfolio of 25 lakh rupees. You have taken a loan of 12.5 lakh rupees. Now you cannot sell 12.5 lakh worth of your portfolio because there is a lien on that until you finish your loan. But remaining 12.5 lakh rupees, you can freely trade as you would do normally. So this is the entire process of loan against securities. I've tried to clarify a lot of things in this video. If you have any questions, let me know in the comments. I would try to go and read your comments and answer as many as possible. I hope you enjoyed this video. If you did, press the like button. Let me know in the comments a simple thank you. It motivates me to do a lot of research for you and bring quality content for you at zero cost. With that, I hope to see you in my next video. Until then, keep rocking.